I'm pleased to have Richard Murphy, CEO of Australian Corporate Bond Company, here with me today. Hello, Richard.
Hi, Stephen.
Richard, first of all, perhaps you could just tell us who the Australian Corporate Bond Company is.
Sure. Look, ACBC, we call ourselves, we're the manager of a range of securities on the ASX that is seeking to give investors access to the corporate bond market via a security called XTBs.
Right. And XTBs, what are XTBs?
XTBs are exchange-traded bond units. So there are 16 XTBs on the ASX. Next week we hope to have another 16, so the range will keep on broadening out. Each one of the XTBs gives you access to the returns from an individual corporate bond. So there may well be, there's a Telstra corporate bond, there's a Woolworths corporate bond, a Crown corporate bond, and each XTB gives you access to the returns from that individual corporate bond. So you can pick and choose between the various corporate bonds you might be interested in for that fixed income part of your portfolio. So you've got your term deposits, and you've got your equities, and you've got some hybrids, and XTBs kind of fit in that space that's kind of hitherto unrepresented on ASX.
Right. And when you talk about corporate bonds, these are bonds that trade in the wholesale credit markets, is that right?
Absolutely. So there's billions of dollars of these bonds traded between an AMP and a Colonial and the various banks, and they're the senior unsecured bonds, so they're the most secure form of security that's really traded, kind of sitting underneath term deposits in that sort of capital structure and well above equity and hybrids. And so they're available in the wholesale market, but they've never really been available on the ASX, and that's why we set up Australian Corporate Bond Company, was to say, well, we can take them from there, from that wholesale market. We can put the XTB structure on the ASX together so that it's traded, cleared and settled just like shares on the ASX, and giving people access to the bond itself.
Okay, so it's really just, you take the wholesale bond that institutions invest and trade, and you put it into the XTB structure, and retail investors can then simply buy and sell those securities as if they were a wholesale investor.
Exactly. In the end, what happens is, as soon as the bond pays a coupon every 6 months, that coupon just flows through the XTB structure and flows out to the end investors. And when the bond matures, the XTB matures, and the money that comes from the corporate, the capital that's being paid back, is just paid through the XTB structure back to the end investor, and then that's it. That XTB is gone, and another one replaces it.
Right. And the XTBs, how do people trade these?
So basically the same way as you would buy and sell shares or ETFs. You go to your advisor, your stockbroker, wherever you access shares. So if somebody's in Queensland, we go to Morgan's and their advisor and say, I want to access some XTBs. It will just be like you're buying a security on the ASX. So there's a code. It starts YTM, and if it's BHP, it's YTM, BHP, YTM, TLS for Telstra. So basically, it's like buying and selling shares, and that was one of the reasons we did this, is put it on the exchange, because the exchange is kind of like the Woolworths, or the shopping centre of buying securities, and all of the brokers are connected there, and Chess is sitting there to kind of hold your security. So it gives you the ease of access of rather than having to go out to an OTC market, which is much more difficult to access for the average investor. Putting it on the ASX makes it so much easier.
Right. And so these securities, unlike a term deposit, which once your money's in there, it's locked away, these securities are tradable, so people have liquidity. There's liquidity mechanisms there for people?
Indeed. So they're on the ASX, you can buy and sell when you want during the trading days of the ASX. And there's a market maker. So there's actually two market makers now, or two liquidity providers. One is a bank, Deutsche Bank, and the other one's more of a specialist trading firm. But they provide bid-offer prices and nice tight prices on the ASX screen for the day, for the 10 o'clock to 4 o'clock in the afternoon. So you would go to your broker if you were selling and saying, look, I want to sell this. The broker, Morgan's, would sell back to Deutsche Bank or the other second liquidity provider, and then you would get it would just settle on T+3 as you would for shares.
Right. And so this kind of security, so an XTB, a corporate bond, sits in the income defensive part of a client's portfolio. Interest rates are very low at the moment.
Indeed.
So tell me, why would an investor still use a corporate bond in a portfolio?
I guess everything's relative. So the cash rates are 2%, term deposits are there and thereabouts, and a little bit higher for some. Bonds sit there, hybrids sit here, equities are up here. So it's about a balanced portfolio, and the market is where it is, rates are low. The interesting thing is that we've done a study on, let's pick some of these XTBs over 3 typical bonds. Let's compare them to leaving your money in rolling 6-month term deposits. And let's see what happens under a number of different interest rate scenarios. Interest rates don't change, interest rates go up. They go up aggressively, they go down first and then up. And so when we did all of that analysis, it did show that because there's quite a decent yield on corporate bonds and therefore the XTBs, it gives you a level of protection against interest rate rises. So in nearly all of those scenarios, the senior bonds did quite well relative to the rolling 6-month term deposits. And it was only when interest rates increased 2% in the next 2 years, which nobody's predicting, obviously, were you better off staying in the rolling term deposit. So there's still a case for, even if you have a view that rates are definitely going to increase, unless they're going to increase beyond anybody's expectation, there's still a case for fixed term bonds. And then, of course, what is the market's 3-year outlook on interest rates? Well, most players have it as, the futures market has it at going down first before back up sometime in 2016. The 3-year government bond market's obviously saying, well, rates are going to be staying lower for longer, and don't expect rates to be above 2%, 2.5% for quite some time yet. So we don't think there is the case for rates are definitely heading up. We're clearly closer to the bottom than we are to the top, obviously.
Sure.
That's abundantly clear. But the outlook over the next 3 years does not look like we're into a very significant rate rise environment. In the States, different story. So they will raise rates at some time soon. Everybody predicts as soon potentially as this week. But that will translate to some sort of a change in Australia. But we still think there's a very, very strong case for fixed coupon bonds as well.
And in a normal portfolio where it has equities in it as well, I guess clearly there's a diversification benefit there, isn't there? Because of the way that bonds will perform versus equities.
Absolutely. So they're generally speaking negatively correlated one to the other. So equities go up, bonds will kind of stay flat or go down slightly. Equities go down, take a big downturn. Bonds will stay flat or go up slightly, as you can see from the data on the pre and post GFC period. And we had a look at that over sort of a 15-year period, and of course you saw the equities market powering ahead before the GFC, then the turmoil of the GFC, and then the recovery, etc. And so the equity market's up and then down and then back up again, whereas the bond index, the corporate bond index, was very, very steady as she goes, and actually rose slightly during the GFC. But it's stable. It's very, very stable and characterized by very, very low volatility. So while the overall performance of equities over that 15-year period was slightly ahead, sort of like 8% to bonds, 6% annualized return, the volatility for equities, as you expect, equities are volatile, was 15%, whereas the bonds were only just over 2%. Right. So, and that screams out, be diversified. If you'd been diversified in bonds and equities, throughout that period, you would have done better off than if you were just in the equity bucket, of course. And everybody knows, don't put all your eggs in one basket. But unfortunately, certainly on the ASX, there weren't senior bonds available. So we're certainly excited by bringing XTBs to market, where people can now see, well, there's my equities and I love them, and here's some senior bond opportunities to kind of flatten out and stabilize the capital value of my portfolio as well.
And even since the XTBs have been listed, with equity markets having been quite volatile, equity prices have fallen, we've actually seen that more recently, haven't we?
I mean, absolutely. If you just look at the XTBs have been there for 3.5 months now. You look at the XTB capital price, the total returns chart, it's steady as she goes. They're never going to really excite you by, doubling in price. No. I mean, if they do, there's something horribly wrong. But the steady as she goes, whereas equities have gone south and other instruments tied to equities have gone south. So they really are a stable capital investment, and that's played out in the last 3 months, the last year, the last 3 years. We've looked at a lot of different periods.
And just some of the issuers of these corporate bonds, and hence the companies that people can access through XTBs. Could you perhaps describe a few of those for us?
Sure. So the first tranche of 16 that we did, there's 13 issuers in there, some of which we've got 2 bond issues for, and they're in the top 50. So it's BHP, Telstra, Woolworths, Lend-Lease, Wesfarmers, a group of the property trusts are in there. So the first tranche was, well, here's the top 50, the kind of largest issuers, and the next tranches are actually coming out in the coming weeks. So they will have the likes of Qantas in there and APA and pipelines, which is a great infrastructure type of investment.
So they're all well-known names, very strong companies.
Yes,
issuing high-quality bonds.
Indeed. So we're broadening it out, and so there will be some. You wouldn't call them smaller companies; they're still in the top 50, but maybe add to the top 100 then in terms of some of the newer names that will come on in the coming weeks.
Okay, that's great. Well, thanks, Richard. Appreciate your time today.
Pleasure.
I think the XTB is a fantastic initiative, and clearly giving access for retail investors to corporate bonds at a senior level is an important development. And as you say, it's something that hasn't been around and hasn't been easy for investors to do, but it's available now. For Morgan's clients, it's important that in terms of your portfolio, you do have diversification. If you need to know more, would like to know more, please contact your Morgan's advisor. XTB pricing is on the daily rate sheet, which is published every day. And please, as I said, contact your advisor if you need more information. Thanks, Richard.
Thanks, Steve.